So if you're looking to get the best possible return on your savings, it seems like a pretty logical and simple rule would be to just go for the account that pays the highest amount of interest. The rate that is higher is going to pay you the most, right? And for most of the time, that is going to be the case. But when you factor in tax, if you pay tax on your interest that you've earned, that could be a different matter. And you might actually be better off going for an account that pays less. So what I'm going to do here is just take you through how you actually work out the difference between a savings account where no tax is due and the rate if you are going to be paying tax on it. Plus talking about the times when you might actually want to be paying tax on some of the interest you earned. So let's start off talking very, very quickly. I have covered this a number of times before about tax on savings interest, just so you know when it could happen. There are 3 core ways to avoid it. There are some other things out there as well. Again, I'll cover those in more detail. But the core 3 ones are premium bonds, which for most people aren't going to be actually the best option for you because the return you're going to get is much lower, but you can put £50,000 into premium bonds and any prizes you get are tax-free completely. More likely than that, or better for more people than that, will be to use a cash ISA. Now, you all know what a cash ISA is. Any of the interest you earn in the cash ISA is completely tax-free year after year, year after year. It compounds tax-free forever. So that's a good option for people to go for. The problem with cash ISAs, or at least the main problem with cash ISAs, is that the rate that they offer on the whole is going to be far lower than you're going to get in a non-ISA account. Sometimes that doesn't, not always the case. You might find a promotion or a bit of competition. We've had a lot of competition recently in that easy access cash ISA market where those rates have been comparable, if not better, than what you get elsewhere. But broadly speaking, if you go for the cash ISA route, although your returns are tax-free completely, you will be getting a lower rate of interest. Which brings us to the last option where you can get tax-free interest, and that is just in a normal savings account, whether it's easy access or fixed or a regular save or a notice account, whatever it might be. For the vast majority of people, you will not be paying tax on the interest you earn there, thanks to something called the Personal Savings Allowance, or the PSA. Again, spoken about this in more detail previously, but broadly speaking, if you are a basic rate taxpayer, which means you earn less than £50,270 in a year, you get a £1,000 PSA. That is £1,000 of interest every financial year, April through to April, that you can earn, and no taxes due on that at all. If you're a higher rate taxpayer, that drops down to £500 a year. And sadly, if you're an additional rate taxpayer, well, then you don't get anything at all. So you'll be paying tax on all of your interest. But for those with a PSA, essentially, if you don't go above that, all your interest is tax-free. And importantly, if you do go above it, you're only taxed on the interest above that amount. So a quick example here, let's say you are a high rate taxpayer. Okay, and you have £13,000 saved at 4%. This will earn you over 12 months, assuming that money is saved in there for a full year. That will earn you interest of £520. That is £20 above your PSA there. So that £20, only that £20 will be taxed at your marginal rate. Your marginal rate as a high rate taxpayer is 40%. So you will actually pay £8 tax on £20. Your total return will be £512. So broadly speaking though, for most people, particularly if you're a basic rate taxpayer with that £1,000 annual allowance, you're going to be absolutely fine. High rate taxpayers, again, rates are still relatively strong comparatively. And if you are a high rate taxpayer, maybe you've got more in savings. So there is a chance you'll go over that. And of course, if you are an additional rate taxpayer, as we said, then you will be paying tax on all of the interest that you earn at a huge 45% rate. Okay, let's quickly have a look then at how you compare an ISA, where your return is all tax-free, and a non-ISA account where you are paying some tax on the interest that you earn. Again, I'm assuming you have used up your personal savings allowance here. This is for the additional interest on top of that. And it's actually relatively simple. You take the ISA rate and multiply it by a number depending on your tax rate. So that will give you, in return, the number that you need to match it. So let's say you are a basic rate taxpayer, and you multiply the ISA rate you find by 1.25%. And let's say that ISA rate is 4% times 1.25. That means you need 5% elsewhere to get the same return after tax is deducted. If you are a higher rate taxpayer, multiply that ISA rate by 1.66. So again, let's take that example of an ISA at 4%. That means you need 6.64% elsewhere. And if you're an additional rate taxpayer, you multiply it by 1.82%. So that ISA offering 4%, you need to find an account elsewhere outside of that ISA thing, they will pay you 7.28%. Now, if you don't know how much you follow the different rates, I tell you about all the different every month, the best ones out there over at becleverwithyourcash.com/savings. We are updating on a regular basis all the different types of options for you. You'll know there, if you do follow those updates that I give you or you check our tables, that is going to be very difficult to find any of those kind of differences outside of an ISA. That is a big gap between all the different options right now. So logically, right now, I can tell you it's going to be very, very, very hard to find any account, if you are paying tax, that is, of course, on some of your interest, that would be better than going for a cash ISA. It's not completely impossible. You do find some of these sort of regular savers, and particularly if you are a basic rate taxpayer, possibly a higher rate taxpayer, they will pay more. But again, that's not on lump sums. That's just on regular amounts every single month. So broadly speaking, if you are going to be paying tax, then you're better off going with an ISA. But that's where the rates are right now. And that isn't always the case. If we take the example, let's say rates in a few years, the best ISA is down to 2%, which might not be unusual. That's where we were just a few years ago before the rate started going skywards. Then to get an account that would match that outside of an ISA as a basic rate taxpayer is just 2.5%. That's a much, much smaller difference and possibly more likely to be achieved. Of course, still very difficult, I think, for you as a higher or additional rate taxpayer, but again, not completely impossible. So you want to take those sums that I gave you, those three multiplications, 1.25 for a basic rate taxpayer, 1.66 if you're a higher rate taxpayer, and 1.82 if you're an additional rate taxpayer, to really work out, to really compare the two different options you've got there. But having said that, right now, the likelihood is that an ISA is going to be the best one for you. I just want to quickly talk about whether you might actually be better off paying some tax on interest that you earn than using a cash ISA. So for a start, you might say, I have no choice, of course. There is that overall £20,000 allowance on the amount of money you can add in a new financial year to an ISA. And there are rumours, as we covered recently, that the government might reduce the cash ISA allowance to £10,000 a year. So you might have, if you've got more than that to save in cash, then you might be forced. You use your ISA allowance, but there's more left over. You might have to put it into a non-ISA account and pay tax on it. But equally, say you might decide you don't want to use that cash ISA. And that's because that overall £20,000 allowance you get every year, that's not just about cash ISAs, remember. That's about all the different types of ISAs you have. And it could well be, if you're someone who has a lot of money, you've paid off all your debts, for example, you've got an emergency savings built up, you've got any other kind of savings funds for immediate expenses, short-term, medium-term expenses covered, so we're talking longer term, 5 years plus, then actually you're probably better off putting that money you have into investments. And therefore, if you're investing, the first place you should be investing is within that ISA wrapper. And the logic for this is, because you're investing for a longer term, again, 5 years plus, and because the investments themselves will compound and grow over time, you would hope that you'll be making a lot more money from investing. Again, there's no guarantee of this. So past performance is never an indicator of what's going to happen in the future. But the likelihood of when you sell those shares finally within that ISA wrapper, the reward you get, the amount you get being far larger than what the tax-free allowances are for dividends and capital gains outside of an ISA, compared to putting your cash and paying over the PSA and paying tax on that. I think you're generally going to be better off looking at those stocks and shares ISAs instead. So that might be a reason why, even if a cash ISA is better for you in terms of the rate, because of the tax you'll be paying on some of your savings interest over the PSA, if you get the PSA, you might actually be better off not doing it at all and investing instead in your stocks and shares ISA. And of course, don't forget, if you are in that situation and you do have larger amounts of cash you want to save, you can also consider premium bonds. And particularly if you are an additional rate taxpayer, they could be a good option for you. So I just want to quickly end this though, just telling you how you can calculate what the interest rate will be after tax, if that's something that you are going to be doing. Okay, if you can't put all that into savings in somewhere that can be all completely tax-free, how do you work out exactly what it is you're going to get? And this is useful for a couple of reasons, but one of them is if you see that real rate, the real return you're going to get after a year, one of it is you can compare that to inflation, because obviously you want to be beating inflation all the time with your savings if you can. If the real rate after tax brings you below inflation, then is there something else you can do with that that's better for you. And of course, you might decide there are other things better for you anyway, even if it's above inflation, but it's effectively quite a low rate of interest, you can do more with it. So that could be, more investing. It could be adding to your pension. It could be overpaying your mortgage. But at least it gives you an idea of what you're actually going to get. So you take the non-ISA rate. This is the rate you're getting on the account where you will pay tax after you've used up your PSA. So if you're a basic rate taxpayer, you want to multiply that rate by 0.8. If you're a higher rate taxpayer, you want to multiply it by 0.6. And if you're an additional rate taxpayer, you want to multiply it by 0.55. So again, just a quick example here. If the savings rate before tax outside of an ISA that you get right now is 5%, a basic rate taxpayer will get 4%. A higher rate taxpayer would really get 3%. An additional rate taxpayer would get 2.75. So that helps you really sort of work out and understand exactly what it is you're going to be getting if you are going over that allowance. Remember, becleverwithyourcash.com/savings is the place to go to find out all the latest rates. My name's Andy Webb. Thanks so much for watching. Check out these videos here for more ways to make the most of your money.